Welcome to the Risk Reversal Podcast. I'm Dan Nathan, joined by Parsh Shah, Portfolio Manager at Kingdon Capital Management. Parsh, welcome to the pod.
Thank you for having me.
All right, this is a good opportunity for us to kind of level set where investors kind of perceive this generative AI trade. I'm going to call it trade in fast money terms here a little bit, because it's one of those things that over the last 2 years in my career, going back nearly 30 years, I've seen very few sort of shifts that have kind of just taken the markets by storm, if you will. And so I'd love to go back a little bit. When you started investing in the markets, how long you've been at Kingdon? Kingdon's a firm, and I just got to tell our listeners, if they're not familiar with it, it's over 40 years old. Mark Kingdon, the founder, he's a legendary investor. He was a legendary investor by the time I got in the business in the late 90s. So tell me a little bit about your seat at Kingdon Capital.
Absolutely. Thanks again, Dan, for having me. I've been investing for over 19 years, and I've been with Kingdon Capital for over 12. I joined as a portfolio manager covering primarily software and services, and expanded to broader tech and TMT overall. So my seat encompasses everything that we're going to talk about today, from generative AI to software and security to the consumer AI, as Dan had mentioned. So quite a broad landscape. Yeah,
and it's interesting when you think about, we've spent so much time on this kind of ecosystem as it relates to the hardware, and then the use cases, whether it be on the public clouds, the hyperscalers and the like, and who are the customers and how are they using this technology and the like. But it really does feel like it's about ready to broaden out a little bit from, to software and services. So we'll hit all that as it relates to security too. There was just on the street this week, there was a couple upgrades of some security stocks by, I think one was Bank of America. They did a double upgrade on Cloudflare, which I always love the double upgrade. But I think some of these folks are like, wait, I got to play a little catch up here, right? I got to think about what the balance of 2025 looks like into 2026. And it might not be NVIDIA. It might not be the hyperscalers.
Sure.
So I'm excited to talk a little bit about that. All right, you and I met in October. We were down in Dallas. Our mutual friend Imran Khan was holding the conference with a K down there. It was really a great group of speakers: Evan Spiegel, Linda Yaccarino, and there was a whole bunch of others. It was really interesting. I mean, it wasn't dominated by AI. There was a great panel. I think there was somebody from GCP and there was somebody from OpenAI, and that was pretty interesting. So when you think about where we were in October, and there was a level of enthusiasm that still existed, now we flash forward, at one point this month, we had the NASDAQ down 13%.
Yes.
We had the S&P down 30%. It looks like that we've taken a little bit of a stall. And I'm just curious, from a market sentiment standpoint, what do you think's happened over the last 6 months or so?
No, great question. Quite a bit has happened. Obviously, we had the elections come and go, needless to say. But when you move beyond that, I think a major debate entered the landscape of AI investing, and that was with what we learned about DeepSeek during January. I think over the last couple of years, the assumption was that the more capital and the more capital intensive you are, the better the models that you will be able to build, and thus your moat will be strengthened. And so that question got thrown for a debate, because when DeepSeek came out, all of us were left to ask the question, well, can you build more efficient models? Do you need to be this capital intensive? And can this broaden out, whereby now the hyperscalers will have significantly more competition? Perhaps NVIDIA's revenue growth won't be as strong as we previously anticipated. And so that's a major debate that entered the investing landscape in January and still continues, quite frankly.
Yeah, so that date was about 2 months to the date when we're recording this right now. It was January 27th. It was a Monday. The data started coming out over the weekend. I was getting blown up by text by a lot of folks who maybe are not tech specific in their investing, but this was something that I think the markets were not set up for, in a way, because there had been so much enthusiasm about a handful of names. When you think about going back to the launch of ChatGPT, back in late 2022, there's been 10 names in the public markets that have really seen, massive appreciation since then. But some of the folks that initially thought, let's shoot first, ask questions later. NVIDIA closed down 17% that Monday. A lot of folks have come around saying, well, actually DeepSeek and the, just the ability to kind of train that model and the efficiency in which they did is a positive thing for NVIDIA. Where were you initially, and where are you now 2 months later?
Initially, I did not view it as a positive, because the narrative started to shift, and the narrative became, as I mentioned earlier, the more and more CapEx dollars that are spent, the better, the more GPUs you buy, the better it is for NVIDIA. And then all of a sudden you seem to have a thesis drift saying, well, actually, the less that you're spending, the more efficient you are, that'll lead to higher generative AI usage and thus still great for NVIDIA. Perhaps that's true, but the market has to go through a digestion period, which I still think we're going through right now, to go from massive capital intensity to less capital intensity. In terms of, is this ultimately a positive? Well, there's a lot of nuance in that, but I think the one thing that I kind of keep thinking about and pointing to is that last week at GTC, Jensen Huang made it clear that relative to last year, the demand for inference and advanced reasoning is 100 times.
Yep.
And so that's a pretty remarkable comment. And it's not just a comment, but it's being backed up by the spend. So while on the one hand, we had a debate shift, on the other, you are seeing this shift towards inference time reasoning. And as a result, you are going to see more compute enter the system. But again, we have to digest some of these new data points that we've seen over the last few months.
And that's Jensen being Jensen. This
right.
is GTC. It's their massive user conference, right? And it feels like he spoke for like 3 days straight. And, part of it is like, they have this headwind of like perception, at least from these, more efficient models. And it wasn't just DeepSeek, right? It was Alibaba came out with one. Baidu came out with one. Ant Financial this week just announced one. And I think this headline is kind of interesting. This is from Joe Tsai. He's warning of an AI data center bubble. Now, Joe Tsai is the chairman of Alibaba. I think we both agree that he's a pretty brilliant guy.
Absolutely.
He and Jack Ma, what they did with Alibaba and Ant and the like here. But it seems like there's something brewing here. It's like a little sovereign AI in a way. Is that, and we also have to go back a couple months ago where President Xi got all those tech champions together and it looked like they were making, a united front. This is years after he squashed all of their technology companies. And now you see what's going on with DeepSeek and these other models. And so I think about it as a way where we're putting through all these export bans of our best technology, right? These guys are trying to say, we don't need your best technology. We're actually innovating on our own side with different sort of chips, which I think is kind of interesting. How do you walk away from that sort of debate? Because this is something that is going to go on for a bit.
It's going to go on, absolutely. And, we actually saw Joe speak at Imran's conference, and it was a great conversation that Imran had with him on stage. And one of the things is that Alibaba is clearly not backing away from AI, and in fact, if anything, their own capital intensity is going to accelerate over the next 3 years.
But it's not to the tune of hundreds of billions the way that like Microsoft
but Dan,
and Google.
But they're catering to the China market. Our hyperscalers are catering to the rest of the world. So it's a much bigger TAM and a much bigger pie that the companies here are going after. So yes, fair. It's not the same magnitude, but it is still multiples higher that Alibaba is going to be spending.
Yeah, no doubt. And so I guess the point of Joe Tsai in this, he was speaking at HSBC conference in Hong Kong the other day. So he's talking about a bubble. He's talking about what the U.S. are doing. That Stargate was OpenAI, it was Masa-san from SoftBank, and it was Oracle, right? And it seems like there's been no shortage of announcements like that. But the one thing I think is really interesting is that we are seeing a slowdown in the rate of increases, right? So on a period over period basis, we're getting down to kind of low single digits as far as like Microsoft and Google and the spend there. Does that sound right? Year over year, it's still a lot, but we're starting to see, and especially after Q4 earnings where we saw, slight revenue growth decel. And we saw the numbers which are staying put. Amazon had a huge upgrade to their CapEx. So I'm curious how you're thinking about what Joe Tsai is saying, what these hyperscalers here in the US are saying, what Jensen Huang is saying.
Right.
So do you think we're going to be at overcapacity at some time soon?
Yeah, it's a great question. It's something we talk about internally all the time. And the answer is yes to all of them. What I mean by that is there an oversupply risk? Absolutely. I mean, you think about all of the spending plans that have been announced this year, to your point, Dan, well over $300 billion just by the big hyperscalers this year. Is that all going to be put to productive use? We still don't know. And many of them have signaled that we will continue to see increases after this year. This reminds a lot of seasoned investors of what happened at the turn of the century with the dot-com bubble. I think that said, where I'm a little more balanced is that if we take a step back and think about why are these dollars being spent? Well, the promise of AI is substantial. I mean, and I think, have we realized that promise yet? No. I mean, a lot of what we've been doing is, kind of chat GPT and chat-like type applications.
They're kind of consumer facing at the moment.
Very consumer facing, absolutely. And some companies like the Metas of the world have talked about how it's helped to accelerate their own internal revenue growth. But promises that have been out there in terms of healthcare applications. This morning, Charles River, one of my colleagues, mentioned to me, talked about incorporating AI into their new lupus drug. You have security use cases, which we can talk about some more, that are just barely at the start, that have we're at the top of the first inning. So the point that I'm making here is that the benefits of AI have not accrued to the companies or to society. Significant dollars have been spent, and we do have a risk of oversupply, no doubt about it. But at the moment, we're still in the mode of we're discovering as a society and as an investment community, what are the benefits that are going to accrue above the AI infrastructure layer?
Yeah, the Meta is a great example because it's one of the few tech companies that like they're able to monetize their own investments in it right now. And you could say, well, Microsoft, they launched this Copilot using OpenAI technology. We haven't heard a whole heck of a lot about their customers using that technology yet. I think it's pretty universal that a lot of folks feel like, healthcare and drug research and the like, or whether it's like, intelligent assistance for doctors and stuff, like that's going to be really game changing. But again, it's probably a couple years away. I want to go back to that Jensen 100x sort of like need for compute. It seems to me that when it's useful, when we hear these conversations about Microsoft doing this deal with a nuclear, company to kind of put, a reactor back on, on the grid and stuff like that, it seems like that's a great headline there. But then the flip side of that, when you hear Jensen talking about 100x compute, where's all that energy going to come from? And I'm just curious, do you guys spend any time thinking about that? Because that seems like one of the things that could be totally a fly in the ointment of the sentiment towards this trade. Satya Nadella, he was on Bill Gurley and Brad Gerstner's podcast a few months ago. And do you remember they asked him specifically if he's still chip constrained? He said, no, we are power constrained. And I just feel like that could be something that takes a little air out of the excitement in this trade.
Well, power was a big theme last week at GTC, and it took a more airtime probably than the GPUs themselves. So absolutely, power is a major constraint. And I think one of the promises going back to NVIDIA and now this upgrading product cycle with Blackwell is that it is significantly more power efficient. It is a transition fully to liquid cooling, which is more space and power efficient than air cooling, and then air-cooled data centers, Also, NVIDIA talked about it with their optical cables, moving from more of a copper-based optical network to photonics and what's called CPO, co-packaged optics. The point is that is a key focus of the Blackwell product cycle and cycles moving forward. So, Satya Nadella and the team at NVIDIA and others talking about power efficiency is a major theme, something that we've been looking at as well. And quite frankly, future iterations do need to be much more efficient. Otherwise, this won't be affordable.
Yeah. What do you make of, and there was a great article in The Information the other day talking about, kind of covering GTC and talking about, incremental performance, from Hopper and the like, but they actually were quoting a few folks saying, listen, I haven't even gotten my Blackwell chips yet, and they're already talking about Rubin. You know what I mean? And so what does that mean to you? Because in some ways, a lot of folks are going to kind of like think about, okay, this upgrade cycle, you know what I mean? Like, and then I have to do it again in a year.
Right.
It just seems like that seems like it's, there's going to be a glut. There's going to be like bottlenecks.
I mean, I'll be completely honest. I'm worried about that as well.
Yeah.
And one of the things I get concerned about with that is when I look at the hyperscalers, when I mean by the hyperscalers, meaning the Meta, Google, Amazons of the world, is that they've spent the last few years actually elongating their depreciation cycles and the useful life of their servers from call it 4 years to 6 years. Now all of a sudden, these chips that they're investing tens of billions of dollars will be made, redundant or over a year or two seems.
So the depreciation is going to have to be sped up after being elongated.
Well, that is a concern. Yeah. That is a potential. And Amazon actually did a slight adjustment on their last earnings call where they very slightly, I think it was by half a year or a year, decreased the useful life. That's not a cash flow impact, but it is an earnings impact. And so, there is some adjustment that has to be had on that front. And in addition, does it create potential for a glut? It absolutely does. But the checks that we do and when you look at the orders, they don't suggest that if anything, you still have a line outside the door for Blackwell. So I think that is a key concern. It's almost being in an annual product cadence, kind of like Apple with the iPhone, yet this is an enterprise product, not a consumer product. So it's an interesting dynamic for sure.
Yeah, but Apple, Tim Cook doesn't come out at WWDC and just say, here's iOS 19, and this is going to be great for this new piece of hardware that we're going to introduce in September, and say, by the way, iOS 20 is going to be off the charts, and it's going to have a new form factor as it relates to the iPhone. It seems like Jensen, in a lot of ways, when you've seen your stock go from like $300 billion to $3.5 trillion in market cap, you got to keep a narrative going. You know what I mean? Now, he's clearly like an absolutely amazing, visionary CEO that we haven't seen the likes of maybe since like Steve Jobs in many ways. But I just wonder, like when I think about Satya at Microsoft, Sundar at Google, Jazzy at Amazon, like these guys, they're asking for forgiveness, not permission. Right. But this is like a really new sort of situation for these companies, right? Because they were just messing around with like ad models or e-commerce models, you know what I mean? Or, enterprise spending on seats and all this sort of stuff. Now, this is a totally different kind of ball of wax in a way. And I'm just curious, when you think about Google and you think about Amazon into their prints, last month, they were trading at all-time highs.
Yep.
Right? And the stocks actually got slammed. I mean, like literally they were down, let's say, including Microsoft, I think between 4 and 8%, all three of them. And then they kept on going. Now, you can tell me one way or another, well, did the market start selling off in mid-February because we lost confidence in these companies' ability to grow and the like here, and valuations were high and competition was getting more severe, and this is weeks after DeepSeek, right? So there was a whole list of reasons why these companies should continue to maybe take a break, take a little bit of a breather, and then the stock should have followed. So I'm curious how you think of the 20% drawdown in all three of those, and throw Meta in there too. How is that just taking a lot of the euphoria out of this trade in general? And is that a healthy thing in your opinion?
Yeah, I mean, like you said, the stocks, these Mag 7 names in particular, went into earnings season at all-time highs, and each of them had a slightly unique situation, but there were some common themes. So if you look at especially Google, Amazon, and Microsoft, all of them in their cloud business saw a slight, Google a little bit more, of a deceleration in growth rates, while they announced on their calls that they'd be accelerating, or at least seeing bigger absolute dollars of CapEx than the market anticipated. So a lot of investors are sitting at their desks, asking themselves, wait a second, here are these names at all-time highs. I already own probably a max position, and they're decelerating their growth and increasing their CapEx, so I have to take my free cash flow estimates down. It wasn't a recipe for the stocks to continue to work. On top of that, you had a broader market backdrop, with tariffs and some geopolitical dynamics, which are obviously still present. So you take all of that together, and it created a pretty, messy setup, I guess you could call it, going into those prints.
Isn't it crazy though? Like, we're almost in April. We're going to be getting to Q1 earnings really quickly.
Doing it all over again.
One of the things that I thought interesting going back in early January, all the Mag 7 basically reported, I think that last week in January, early February, and they had all kind of given some soft guidance on CapEx. It kind of snuck out, the week or 2 weeks before that. And so I wonder if they're going to do that again, because the idea of kind of, let's just say, I don't expect an increase to 2025, CapEx. If anything, and I know a lot of people who are much smarter than me about this stuff, they're like, there's no way they're going to pull back on those CapEx numbers. But to your point that you just made about if there's a greater decel and say in revenue growth, then they're going to have to some degree.
Yeah, I mean, no, it's a great point. The one company I think to watch really closely on that front is Microsoft, because Microsoft will be on its fiscal third quarter earnings call, and typically they don't update for the out year CapEx dollars on that Q3 call, but they have provided, Amy Hood has, the CFO, broad strokes on what the next fiscal year could look like in terms of revenue and operating income growth. Could she provide an update on the CapEx? I'm not banking on it. Most, if not nearly all, investors are not banking on it, but it certainly is possible, because if you take that in conjunction with channel checks that have been coming out to suggest that they've been canceling some long-term data center builds, and the evolution of their OpenAI relationship, it's certainly possible. I'll certainly be watching closely for that. As for the others, it seems unlikely, but you never know. But Microsoft will be the one to watch.
Let's talk about Alphabet Google really quickly here, because this is one where I don't know why there was that enthusiasm heading into the print. It was trading at all-time highs, but the stock, is down at its lows last week or so. Is down about 24% from those recent highs. It's rallied a little bit here, but this is one going back to, again, early 23 with the Bard launch. It just seemed like a train wreck, one after another. But when you think about Meta, which you just mentioned, their ability to pivot a lot of that spend from the metaverse and kind of reinvest it or repurpose it, right? And they're getting those benefits within their own, ad delivery and the processes within what they do. And then the valuation was something that people felt pretty good about. You could make a lot of the same arguments about Google valuation easily, the platforms in which they have to put this Gemini technology across, whether it's Gmail, whether it's YouTube, the list goes on and on. Why do you think Google is in such a penalty box on a relative basis over the last couple of years?
Yeah, I think that no, it's a great point. Valuation, to your point, Dan, is extremely undemanding. It's probably last I saw maybe a 20% plus discount to the market. The issue is the classic innovator's dilemma question that scares a lot of big investors, which is essentially that is my cash cow, and it's not just a cash cow, it's a growing cash cow, one of the best business models ever, search, going to be disrupted, and massively so. And going back to the conference where we met, a really astute investor asked a panelist from Google, how do you basically grow through a period of what could be one of the biggest innovators' dilemmas we've ever seen? And, it's one of those unprovable dynamics in terms of Google will get through this and they'll be okay. It's difficult to prove. And so investors just, are not yet giving them the credit they'll be able to do it. Now, I think it's important to remember that in 2024, Google search revenue accelerated in the second year of this, massive AI wave. Last quarter, they grew over 12.5% on a over nearly $200 billion business. So, what gives? Because I know you and I have talked about this. I've talked about this with a lot of others. Everyone says, "Well, my search activity is so much lower. I'm not searching anywhere near as much as I used to. I'm using Perplexity. I'm using ChatGPT. I'm using Grok. I'm using Claude and others." And I don't know if the search TAM is expanding and search usage, is just increasing that much. But Google came out with a data point that was a little under the radar a few weeks ago, that they've hit 5 trillion searches annualized. And doing some back of the envelope math and connecting the dots, that could be up 20% year on year. And so over the last 2 years, commercial searches clearly have not slowed. Search activity continues to be up and hasn't seen signs of waning, it appears. So we'll see, but at the moment, it's just in a bit of a pickle because, again, investors don't want to be caught in an innovator's dilemma, whereas Meta doesn't have that issue right now.
Yeah, and the other point is search is only useful if you're clicking on the links and you're getting the ad impressions and and some folks can get spooked in a recessionary environment that you're going to see a pullback, right, in advertising spend. So that's one of the things that I think some of us forget, how cyclical advertising is in general. And then you think about how messy those search results are on Google. You get the overlays, you get the sponsored links, you get the blue links, that sort of thing. And if the overlays, you don't trust them the way you would ChatGPT or Claude or Perplexity, which is obviously an aggregator of a lot of those models, then you're going to go to one of these others. My behavior has changed. The Perplexity, user interface looks like Google did. You know what I mean? It's really simple, but the answers in which you get are just, I think they're just far better than anything you do on Google. We talked about the Mag 7. I call it the Faithful 8. Once Broadcom kind of entered that $1 trillion market cap, now it's since come back again. What did you make over the last couple of years as a portfolio manager of this concentration among these, let's call them these top 10 stocks that were half the weight of the NDX, the NASDAQ 100? They were 33% or so, the S&P 500. Is this something that you've gotten used to over the course of your career? Or is it just that the numbers are so big? We had 8 stocks with $1 trillion market caps, some with 2, some with 3, that sort of thing. How did you guys shake out on the concentration?
Well, I think you hear about market concentration, and you talked about the history of Kingdom Capital, and Mark, our founder, often talks about previous episodes where you saw this concentration, whether it be the .com bubble or even back in the 60s with the Nifty 50, and you think, oh man, that's troubling, that's bad. I think there are some differences in nuance, though, again, because you have a situation where these companies are just compounding and have been, at least, especially over the last couple of years, at such high rates. These, let's call it Mag 7, Fateful 8, however you want to look at Fateful 8, have been growing at a faster earnings clip than the rest of the 492, let alone the small mid caps and the Russell 2000. And so as fund managers, we're always looking for the new story, the kind of diamond in the rough, something interesting that's not, these top 7 or 8 companies. But at the end of the day, you have to perform. And if they have presented opportunities, granted, recently it's been a bit of a shakeout. And so the concentration is there, but each company is different. They have massive TAMs, and some are better positioned than others. And I don't think it necessarily spells a major trouble just because we have this concentration issue, but it is worth watching, and we are.
Yeah, I guess the point I would make is that, okay, so they led over the last couple of years, a raging bull market. These, let's call them 10 names. They were a big part of the earnings, upward earnings revisions for the S&P 500 that continue. I mean, a lot of folks thought, coming into 23, we're going to have a recession. We had an earnings recession in 2022, the recession possibly going into 2024. We've never had one. So if we were to see, let's say, these companies where we've already seen revenue growth rates kind of tweaked down by the street, but if we see pressure to earnings, and by the way, the weak dollar should help that, right? Like, kind of buoy that a little bit. That's where the concentration becomes more interesting to me of like what the potential downside is if we do kind of hit, growth kind of issues one way or another. Let's talk about custom silicon. This is something you and I have talked about. When Broadcom, introduced that guidance in, I think it was mid-December. The stock went up in 2 days 40%. Okay, and it got over that $1 trillion mark. We'd just seen Marvell do a very similar sort of thing on a much smaller scale as far as market cap terms, but it had this huge move. And the narrative is that all those major customers of NVIDIA, once they've gotten through training the models, as they go into this inference phase, they want more custom chips, right, to do these processes. That was the excitement about that. Hock Tan at Broadcom, he gave this crazy TAM, right, for custom silicon going out to the end of 2027. You could have driven a truck through it. I think it was like 30 billion to 90 billion or something like that.
60 to 90.
All right, 60 to 90. Okay. Yeah. So midpoint obviously being 75. And then the question is, how much were they going to capture of that? It wasn't just them. So Broadcom has kind of filled in that entire gap. It went, to basically 250 from 180, and here we are right now at 189. And you would have thought that even the earnings that they were able to put up in the guidance just a few weeks ago, that would have been enough to kind of move the stock a little bit higher. It's gone nowhere.
Well, I think with Broadcom specifically, it is, to your point that you just made, I mean, these are trillion-ish market cap companies. Hard to decouple, even with great results, if the rest of the group is trading weak, isn't trading well. I think that's one thing. And I think the other is that in December, the promise that was bought now has to meet reality. And Broadcom has a great track record of doing so, but now the proof has to be in the pudding, and that's what's really on the come here. And so you had the euphoria, the enthusiasm, the excitement. Google is one of their big custom silicon customers. They will be spending with them. They are ahead of the game on that with TPU. And now we just have to see that come to light. And to the extent that these names are somewhat, at least on the semi side, somewhat tethered and anchored to NVIDIA, well, it trades at a 3 or 4 point premium to NVIDIA. So again, hard for it to run away when NVIDIA has been kind of stuck here.
All right, let's go down the ecosystem a little bit. We spent plenty of time talking about hyperscalers. Now, let's go to the servers, and then let's go to the components other than NVIDIA GPUs a little bit, because what we've seen, first of the hyperscalers, we saw a revenue decel. We just covered all that, right? And then if you think about what we've heard from the servers, if you just think about Dell and Supermicro, let's spend a little time on there. Maybe we don't have to waste a lot of time with Supermicro. There's a lot of hair on that story one way or another. We talk about this stuff on Fast Money all the time. There's like a gazillion other stocks out there. You don't have to get involved in the ones that have investigations going on and the like here. So let's talk a little bit about Dell, because it feels like it's kind of a one-horse race in AI servers with them.
Well, you mean a one-horse race?
From a competition standpoint.
Gotcha. Well, in AI servers, they do have Supermicro as a major competitor there, and we've seen announcements from HP, Lenovo, and the like. AI servers is interesting. Last year at this time, people could not get enough of Dell in their portfolio. You probably recall. I think it was the last year in early March, the stock gapped up 35% when they put up a big AI server order number. And I just talked about euphoria and excitement, and then the aftermath. The aftermath has been a lot more challenging, and it's not because they haven't had good AI server backlog. In fact, they won a $5 billion AI server deal with XAI. But the challenge has been the margins, and Dell's gross margins have come down. This year, if they achieve their guidance, will have been about 250 basis points, I think, over the last couple of years. And they've been emphasizing. To be fair, Dell has been very clear that AI servers come with lower margins, but the gross profit dollars, will be higher.
Yeah.
But the market simply, I don't know if it's just they haven't cared, or some of the other segments, which you can talk about, have been a bit challenged, such as the PC market. And as a result, that stock has been, in a range for quite some time, despite what I would argue is, executing really well on AI servers. And just one final point on this is that while the gross margins have been challenged, they've met or exceeded their operating margin targets. And in fact, their OpEx was down last year. They talked about AI actually contributing to that. So you look at it and I'm like, they're slightly beating earnings estimates. They're executing well in AI servers, but there's a lot of fear about, our AI servers going to be commoditized?
Yeah, for them, fiscal 2024, they had 24.25% gross margins, expected to be just a little bit under 22%. So the operating margin, the way you just kind of broke it out, that's kind of the more important, I guess, metric right here. But the flip side of that is, Supermicro, I think that they had 11% gross margins like 2 quarters ago when they announced. So like when I say it was a one-horse race, I guess I meant from a profitability standpoint, and not
Understood.
that 22% gross margins are particularly, phenomenal. But when you think about hardware, ultimately this all gets commoditized. And, I don't know. I find this like the least interesting part about it. If I go back 25 years and I think of the server market in general, you know what I mean? And then I look at the underappreciation, other than that period you're talking about, March of last year, and you saw that big run up, but then the expectations got so high, and they reported the next quarter, and the stock went down 20-some%, and then didn't see an uptick for 3 months.
Well, and one of a few things with Dell I should highlight is that they have that much higher margin profile than a Supermicro, because Dell does have some of the bells and whistles, if you will, that corporations like. They have the storage, they have services, and so they have an ability to layer those in, and attach those to AI servers. And they've talked about a 2 times attach rate for their storage and their services. But this has been largely a cloud market, and the cloud buyers are saying, hey, Dell, thanks for the AI server, but we can handle the rest. And we might even use an upstart like Vast Storage, a hot pre-IPO company. And so I think Dell has the challenge of convincing the market via convincing its customers that they have a big attached play at hand here. They might, when the AI market brought in some bigger enterprises that are non-tech oriented, but so far that hasn't played out, I think, as quickly as investors would like. So tough end market for sure. AI servers are growing top line very, very quickly, but difficult to, extract margins, which has been the big challenge.
Right. So let's talk about storage and memory, because I'm looking at what, Western Digital. It's basically trading very near 52-week lows. Micron is trading very near 52-week lows.
Right.
And I put that together with Dell, which is also not far off. It just seems like as anything away from NVIDIA hyperscalers, no one wants any piece of it. And then again, we just talked about that all of the hyperscalers were down 20-some% from their recent all-time highs. So it just seems like to me that the fever has broken in this trade to some degree.
Well, no, absolutely. It's a great point. Micron just reported last week, and initially the stock went up. They beat earnings. They had very bullish commentary in their press release, and going into the earnings call, mostly it was very good. There were some good vibes going around because what they highlighted was their high bandwidth memory, which is tailor made for AI GPUs, was beating and exceeding expectations. But then as folks looked more under the hood, what they saw is that gross margins are again down quarter on quarter. Now, Micron had highlighted that throughout the quarter at conferences, but nevertheless, it left people asking the question, well, if I'm seeing all this strength, why, and AI is providing so much goodness, if you will, why are your gross margins going down quarter on quarter? They had some issues with the NAND business that they have that's subscale for Micron and has been probably negative margins at the moment due to oversupply. But if we just take a step back and think, well, again, if AI is supposed to be providing all of this value add further down the chain, why am I having margin issues at Dell? Why am I having them at Micron? Why am I having them possibly at some other, optical component companies and the like? And so I think that's been the challenge, and why one of the reasons why Micron, kind of quickly faded last week, and I think it was down 7-8% on earnings.
You kind of alluded this before. We're like, where do these use cases, where do they emerge, right? And so cybersecurity is one of them. And we talked about, the double upgrade in Cloudflare. There was also one in CrowdStrike. Everything with the crowd was doing pretty well this morning. This is on Tuesday morning or Tuesday afternoon as we're recording this. Let's talk a little bit about what you think this means for cybersecurity. And is this an area that you're really focused on for the balance of the year?
So I think with cyber, the companies, obviously a lot of companies with a lot of different flavors here, but I think there's a few things that are very positive for the cyber companies if I look at it from a top-down perspective. So generative AI is expanding the attack surface. What I mean by that is sophisticated hackers have a bigger toolbox to work with, essentially, with generative AI. As a result, you need greater protections. And not only that, but relative to, say, traditional software or SaaS seat-based software, you have the potential to expand your market in cyber. And the reason is that these AI agents are on the come, and they too will need protection. So not only us as humans will need to be protected inside the workplace and outside as well, but also you have an increased proliferation of agents, and you have companies like Okta, one of the leaders in the identity security market, as well as CyberArk, much more vocal about this. So I think that's really interesting. It's early days, to be very, very clear, but you have TAM expansion again with the increased attack surface and the proliferation of these agents.
Yeah. So talk to us a little bit about agents in general. This is something that, Mark Benioff at Salesforce has been pushing really hard. They've, released a suite of products. It doesn't seem like he's talking about it. It's seen this massive uptake off a very low base. But then when you start talking the financial contribution, it's not particularly, that great. And you're thinking about a company that's growing probably mid to high single digit revenue right now. So it's not a hyper growth company. Is this something you look at their ability to kind of grow this market and integrating across a lot of different industries, right? Because they touch a lot of them. Is this the potential in the not so distant future to be a real growth engine for some of these SaaS companies like Salesforce?
Potentially. I'd emphasize that word potentially, because you take a Salesforce that is call it $35-40+ billion $billion revenue company currently. And so I think Mark Benioff's enthusiasm combined with, the guidance, perhaps a little bit more muted, is something that people have been asking about, like, how to marry the two. And you'd say, well, look, like this is a massive scaled company. It has 4 established clouds already. And then you have this agent force, great product, feedback in terms of the usage and customer feedback has been positive, but you're starting, to your point, Dan, on a very low base. So to move the needle in any given year, particularly this year, is really difficult. If this doubles and it contributes a few $100 million to the overall revenue, that's barely a drop in the bucket, and that might be an aggressive assumption. So agents are evolving. This is going to be a market that is going to play out over many years. But they're smart to stake out a position here, but it's still just not going to move the needle in the near term.
Do you spend a lot of time, thinking that's a good opportunity, looking a year or two out for them? But like investors have looked at a company like Adobe, thinking that like all this innovation is coming at their kind of core suite of products, and the stock is down considerably from the highs. In early last year, it's down nearly 40% or so. It's barely seen an uptick. So I'm just curious, how do you think of like some of the ones that have major headwinds?
Yeah, Adobe's been a really interesting one, and it just is not getting the benefit of the doubt. And I know it's frustrated them, unsurprisingly. And this is a company that you think about over the last decade plus, they were a leader in going from license-based traditional software model to SaaS. And they essentially executed beautifully through that period and had, pseudo monopoly in their creative business. And so as growth has slowed coming out of the COVID pandemic and, we're seeing closer to quality, low double-digit growth, investors are saying, wait a second, I have what was a monopoly, maybe not so much anymore. And I have all these generative AI tools. I remember last year when OpenAI Sora came out, the Adobe stock got really hit hard. And it's been just kind of like we were talking about with Google earlier. It's just been difficult for them to sort of unprove this narrative that's out there. And, I think it was during the holiday season, Coca-Cola put together this really interesting this ad campaign, mainly using Gen AI. And it also caused a bit of a freak out moment in terms of, oh, wait, are Adobe's tools going to be as prevalent, in these advertising and marketing campaigns going forward? They're prepared. They're not going to, go away, but by any means. I mean, it's a phenomenal company. But again, we have a lot of questions, and again, a big reason why the stock didn't hit so hard.
Yeah, before we get out of here, let's talk about some of these consumer internet names that you focus and how you think that, generative AI either serves as a headwind, like we just described with like an Adobe, or you see it as something that could be really additive. And maybe we could throw an Airbnb, an Uber, Instacart, like some of those sorts of names, because again, I mean, they heavily rely on certain components of this sort of technology, but maybe in some instances, they could be, kind of headwinds, especially when you start thinking about agents and how they might work, for folks, who are kind of using these services and products in general.
No, it's a great point. So when OpenAI came out with, I think it was January of this year, released Operator. Operator is essentially an agent that can go on your browser and essentially order. I think the vision is ultimately be able to order food for you, or buy plane tickets for you, or what have you. And so it was a bit of a, I don't want to say a freak out, but definitely a oh my god type of a moment, in that are they going to basically render Instacart or Booking.com and companies like this essentially useless, or at least circumvent them. But then these are their partners with the OpenAI Operator launch. Instacart is one of them, and that's an example. Cart is of a company that is still fairly manual intensive. The shopper goes around, picking up the items that you order. And while the shopper dynamic is not going away, one of the things is that they can be so much more efficient if they have an update on what inventory does my grocery store have. Are the avocados that I asked to pick up, are they available, or what have you? And so the potential to improve the unit economics for a company like an Instacart, for example, which is a leader in grocery delivery, is immense. And, this is a company that unit economics make all the difference in the world. Delivering items from point A to point B is a fairly labor-intensive task. So any efficiency that can be gained is tremendous. And they, too, have an advertising business that provides some pure profitability. And there's generative AI potential in terms of improving conversion for a company like them, such as what, say a Meta has done already and has shown that, can be achieved. So I think there's a lot that can be achieved that hasn't, that we barely scratched the surface on some of the consumer internet use cases. But again, I think I want to watch really closely what a OpenAI Operator and other products like this coming out will do. The OTAs, like a Booking, have been called into question on this very dynamic as well, because Google search is such a big part of their lead generation. But again, they have the relationship with the airlines. They have the relationship with the hotels. And so that's going to be difficult to overtake, and I wouldn't count them out.
All right, man. We could have done this all day long. At least I could have done it all day long. Yeah. I'm sure you're getting
thanks so much. Really appreciate it.
So that's Parth Shah. He is a portfolio manager at Kingdon Capital. Really appreciate you being here. Hopefully after Q1 earnings, Q2 guidance will come back.
That would be great.
All right, thanks.
Really enjoyed it. Thanks.